We're beginning to see some quite decent moves now in the risk-on asset class. Equity markets moving quite closely back to their year highs. Certainly here in the UK, the FTSE 100 has been touching 5,900, and that was a level last seen in March. And obviously, if we can continue this rally, think about 6,000 for the first time in 2012. That's going to put a little bit of cheer into the market. Actually, the more impressive market is the S&P, the S&P 500. It's now up at a 4-year high, trading around 1460. And I think an interesting level on the S&P will be 1529, because for chartists who want to go back a much further period of time, if we go back to, say, 1980, it's hit 1526 twice before, at the end of the tech boom, and indeed just before 2007, in the sort of just prior to the financial crisis. It looks like two very large double tops, and as we approach 1526, that's assuming that this rally continues, then that will be one very big number to take out, because as I say, if we were to produce a chart over 30-40 years, that would represent quite a big breakout. So plenty of optimism around. It's being driven by the knocking down of hurdles, is the best way of putting it, in Europe. This week we had the German Constitutional Court effectively give approval for the ESM facility. It does come with conditions attached. That was always going to be likely the case. They want to limit Germany's exposure to the ESM facility to $190 billion. If it needs to go over that, it has to go back to the lower court. But these are all the sort of natural situations you would expect them to put in place. So largely it was given a clean bill of health. And of course we've had Ben Bernanke in the US this week launching QE3, as was predicted last week. The shape of this programme is interesting in that it is targeting private assets. It is also unlimited by its nature, at around $40 billion per month, and that will keep going until they start to see employment coming down. The Fed has a dual mandate, unlike the ECB and the UK Bank of England, which primarily targets inflation. Over in the US, they also do have employment as one of the key criteria, and that's been a cause of much concern for them over the course of the last few years. So let's look at some charts and really just look at some of these moves that are developing now. And this first chart is of the euro. Off of those lows, this is when Draghi predicted that he would launch something with unlimited firepower and do whatever was necessary for the euro, and he really has. He's really put some life back into the euro at the moment, and so markets are definitely going with this as we speak. And the other key beneficiary here has been some of the longer term borrowing numbers out of Spain and also Italy. I've highlighted the Spanish chart here just to show that really since the launch of this unlimited buy programme in early September, we've seen yields on 10 years coming in from 7 to 5.6%. Now importantly, it is important to remember that the ECB will not be doing anything in the 10-year market. They're really concentrating on the 2 to 3 year market, but it is bringing risk money out, because the belief that the ECB will be supporting the short end of the curve, it's really giving more comfort to longer term investors there in Spain. 5.6, I mentioned last week. Will we see that continue to drop down to these sort of levels, maybe sub 5? We've certainly seen Italy 10-year money drop below 5% for the first time in many months this week. So again, the trends are all looking quite favourable for risk on assets. Just a couple of other observations really about this. Germany, that has proved to be very much in the safe haven status, has seen yields begin to rise. This is the yield on 10-year money, and again it's really had the opposite effect in Germany. So a lot of risk-off money that was hiding, for want of a better word, in the German 10-year money is now starting to move out into riskier assets. So that's reducing the price of German bonds and raising the yields there up to around 1.9. It did touch a low of around 1.2 towards the end of May. So there is a sense of money coming out of a little bit of Germany at the moment into some of the other more riskier assets. As always, we've seen these trends reverse very quickly, so it's something that needs watching closely. Now, as you get more stimulus, you do indeed start to get some of the asset classes that will move higher on the back of stimulus, and I'm looking here at the price of iron ore. This as commodity came off very, very sharply during the course of the last couple of months, but we have seen a bounce back. If we would take a 5-year view of the financial crisis, what we will say is that one of the key beneficiaries has been commodities, with average gains of around 30 to 35% over 5 years, compared to other asset classes which have obviously dropped. So QE has really been benefiting from benefiting the commodity asset classes, and so we may see some further tick up in that. I highlighted last week Rio Tinto as a stock that I thought was probably worth playing, particularly as it was coming off a low end of the year chart. It looked like a good time to maybe put some risk on there, and as we can see here, they're moving up towards £33, and still potentially has further to go on this current trend. So miners are leading the charge, and that's certainly assisting the FTSE 100. Now, so whilst there's plenty more cheer in the financial markets, it is coming at a time where we're starting to see a little bit more pain around in the economy, and profit warnings are still having impact. This is Burberry, which is warning that sales are slowing down at the top end, and we've seen a 25% correction on its stock price. Primarily, the downturn is due to the fact that it was just a complete surprise that they were warning, and the rating on the stock was quite high, and they're down to 1087. To get this stock down to a more market rating in light of uncertain conditions for them, there is a feeling that they may have a little bit further to fall before they become cheap enough to buy. But also we are seeing more M&A. Companies are looking at some consolidation in the market, and BAE Systems is the latest to attract the attention of an industry player, EADS. Much uncertainty about the timing of any deal that can be put together here. It will be a merger of interests if it does proceed. So speculators drove it higher. I think sort of sense prevailed, and the stock has come back because they do appreciate putting two defence companies together. There will be plenty of interest from the governments around the world about how that will work, particularly in Europe and in the US. The final chart for me today, though, is really just maybe a telltale sign of what is happening in the real economy. So financial assets are inflating, but real economies are potentially declining still at this junction. This is the Baltic Dry Index, which is a representation of shipping rates around the world, so as goods are travelling. This is a 1-year chart. You can see that this is nudging the lows that were seen earlier this year, but if you would pull out a 10-year chart or a 25-year chart, you would see that this really represents the very low end of the Baltic Dry Index at the moment. So certainly not a demand-supply issue in the shipping markets.